because I've seen marriages destroyed by one of the spouses taking undue risk and everything blowing up in their faces that they're going back to work and that type of thing.
Well, there are a lot of investors taking a lot of risk with their money, and that becomes more apparent when we see market volatility. What should we do about risk? How much should we take? And are there defensive strategies that can help us out when markets become turbulent? We'll talk about that today on Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, founder at TJ Stearns Inc. Hopefully, Tim, providing us a little levity on these crazy market conditions. Anything that we can do to remain a little bit more stable-minded, even when the market is not so stable?
Well, one of the things I don't like to be able to say I told you so, but we've been talking about this for quite a while that we were due for volatility. I mean, markets don't always go up. And I think people lose really quick sight of that. And, that's why to me, it appears so important to meet with someone to kind of go over what is the risk in my portfolio. I don't think, people are, they don't want to get beat by their neighbors, right? So they're, doubling down into these stocks that are not the Magnificent Seven right now and that type of thing. And there's just a lot of volatility and this comes into play where you need to be defensive. I mean, the last thing you want to do is lose all that money you've worked so hard for over your whole career. If you're 25 years old and this takes a hit, not as big of a deal as someone who's 60 looking to retire, or someone who's 70 and is retired and just saw 25% of their net worth wiped out.
So there is a time and a place to be more or less risky. But I think, Tim, that when we see markets going up, we're all okay with taking risks. When we see the markets going down, that's really when the rubber meets the road and our
Yep.
steel is tested, so to speak. And there is an appropriate shift in the amount of risk that is advisable, that we should be taking over the course of our lifetime. But maybe during the midst of market volatility is not the time to make large scale shifts in strategy. What are your thoughts on that? Is now the right time to back up and take an account of our accounts?
Well, yes, it always is a good time to do that. You should always have your finger on the pulse of your portfolio. And then make sure you're having that discussion if you do have a spouse, so that everyone knows kind of going into it. Because, I've seen marriages destroyed by, one of the spouses taking undue risk and everything blowing up in their faces that, they're going back to work and that type of thing. So yeah, I do think right now is a great time to take, inventory and figure out what's the next step. I'm glad to say that, most of our clients, own annuities. They own things that have hedges. They own stop loss type vehicles. We're not perfect. I will say that again. We are not perfect, but we are definitely not a buy and hold company because I don't believe in it. I've 31 years in the business. I've seen a lot of people get hurt by being, greedy. I'll use that word. And they don't want to miss out on something. And then when they get so far into it, they don't realize how to get out of it. So when we're doing our plans for people, we're building in these defensive mechanisms, and then staying to the plan. Right now, my clients are able to pay their bills by having guaranteed money through annuities.
Well, again, we are talking with Tim Stearns, CFP. If you've got questions, if you would like an assessment, an evaluation of your current accounts, your investments, and your plan, if you would like a plan designed, the thing that is going to help you move through both good and turbulent times in the market with enduring confidence, that's the the goal of the Protect and Grow written retirement blueprint, mapping out where you are, the goals for the future, and the specific pillars and the foundation of how to get from here to there and make those goals and hopes and dreams realities into the future. If you'd like to get that put together, pick up the phone and give Tim Stearns, CFP, TJ Stearns Inc. a call, 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, market downturns often trigger fears of declining asset values, obviously, but also the gut reaction of now that we're seeing losses, we want to back up and move to safety. There is a time and a place for risk. There is a value for growth inside of a portfolio. And just because the market is temporarily not moving up does not negate the need, the necessity for some amount of our dollars exposed to risk in order to achieve more longer term growth.
Even my mom, who's 95 years old, is still in the market. I mean, I don't know where else you can achieve to beat inflation, and that's holds big, with what we've gone on the last 3 or 4 years with inflation being out of control. Those are the ways we can do that, but you also need to weigh that in with the fact that, I've got her in fixed income products that, she can, take respite in the fact that, not all of her money's in the market.
Yep. So balance, right? And
Exactly.
that is important. That balance shifts over time. A 25-year-old, a 45-year-old, a 65, and an 85, they're going to have different appropriateness of risk exposure, right, Tim?
Right. But unfortunately, most of the baby boomers that have been coming in here from our show, our workshops, our retirement classes have way too much stock. I'm talking about 70, 80%. I marvel at it. It's like we've forgotten the days of when the markets can correct, and it's just out of whack. When I first got in the industry, people weren't taking this much risk.
Do you feel like that's because they have seen it and experienced more risk and downturns previously and therefore are sort of accustomed to them and feel like things will always bounce back? I almost equate this to recency bias,
Yeah.
where we only remember the latest thing. Because I remember back in like 2007, 2008, when or shortly thereafter, when I read articles that younger people, like 20, 25, 30-year olds, were not taking any risk because they were so afraid of losing money, because basically they had not seen market turbulence or downturns of that
Right.
nature before. Whereas baby boomers were, taking more risk at that point in time. And here we are 15, 17 years later. A lot of time has passed, a lot of gains have been made. There's more risk on the table, and yet we are closer, if not already in that retirement phase.
Right. But I feel like this is different. This seems really a whipsaw type effect. One day crazy up, the other day crazy down. We're making records that I don't like to see being made. I like the slow and steady wins the race type of thing. And I'm finding, I looked back in May of 2008, the market went down incredibly. It was really bad, but it spiked. And then everyone went back in June.
Hmm.
And what happened in June? The bottom dropped out. And I'm seeing that, most investors buy at the wrong time and sell at the wrong time. The average investor usually does about 3% in the market,
I,
over the
I,
years.
I've actually read that headline or saw that story that one of the days recently where Trump had announced that he was putting a temporary hold on the
Yeah.
tariffs for certain countries, and the market bounced up a pretty significant point value that day. And the headline or the story that I heard or read was that it was the best day in the market since 2008. And then I
Right.
sort of remembered what 2008 was all about, and I was like, well, that was not a very good time in the
Right.
market. How was that day so good in a bad year? But Tim, to your point, like it whipsawed at that point in time, and it was kind of a phantom recovery in the midst of the moment.
And that brings me back to that you need to have people watching the store, as they say, making sure that you have things, I just see so much leverage where people are just using all the money that they can to be in the market, and now look what's happened. So is it a good time to get back in? I don't know, but now is a better time than ever to get a plan
Mhm.
and make sure that you're going to stick to that plan. I see so many people calling in from the show from back a couple weeks ago. They're emotional, and emotional investing is not good for anyone. Our the way we do our strategies, it takes emotion out of the equation. We're either in or out. That's how we do it. But I mean, people need to be understanding to what risk can be managed and what can't. And that's just education. And, I think right now it would be appropriate to offer our book, because people are kind of skittish right now. And I'd like to offer to the first 10 people that have over $2 million in assets to give us a call. We'll get the book into your hands, Solving the Modern Retirement Riddle. I speak of things like this that are happening, and tell people how we get through it and then if needed around it, and make sure that people are getting to the promised land of retirement and staying there.
Yeah. Several sections of that book, Solving the Modern Retirement Riddle, specifically deal with volatility, but not just volatility, many of the risks that we face into and through retirement, and then how to address them. Market risk is, of course, what we're addressing today. And the first thing that comes to mind when people say, investment or financial risk, but there are many others. There's healthcare expenses, there's taxation, there's inflation, there's longevity, just to name a few, sequence of returns risk. And I know, Tim, you spend a great deal of
Yep.
time in that book setting up why we are actually particularly exposed to those risks with the status quo kind of financial approach that many have taken over the last 3, 4 decades, this generation of savers, and how we are rethinking the financial structure, setting up that protect and grow blueprint so that we can address and minimize or eliminate some of those risks from impacting our financial progress. So again, the book, ladies and gentlemen, 10 copies available. First 10 callers with 2 million or more saved or invested for retirement. Pick up the phone now to receive your copy. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, we are often told and taught to take risk with our money in and through investments for several key reasons. Rooted in the idea that risk equals inherently higher returns over time, right? Over time, the stock market has generally shown to keep up with or surpass inflation better than interest bearing savings accounts. But it's not necessarily guaranteed in any specific period because, as we've seen, investments can also lose money, but there are reasons like to achieve those higher returns, to beat inflation, to build wealth over the long term, meeting future goals, and risk can be managed. So let's talk about the case and the strategies for defensive minded investors. First, the case for having some more conservative element, even in our investment portfolio. There's also a reason for that.
Well, I mean, one of the areas that we've moved our people to are, high quality bonds, U.S. government T-bills, that type of thing, that takes kind of the risk out of the equation. Also, investment grade, corporate bonds, that type of thing. The other one that I really like are dividend paying stocks that can kind of, answer the day, and having covered calls on that. That's another thing that we've done. And we've had people come in and they're coming in with some heavy duty stock portfolios and showing them right now it might not be the best time for that. You're 65 years old and you just retired and you're getting beat up pretty good. And God bless the do-it-yourselfer out there, but I don't manage my own money. I use institutional money managers. So, I practice what I preach. I leave it to the experts. And some of those areas, like I said, we're going into high quality bonds, dividend paying stocks, and money markets.
So a few of those options, Tim, things that you are also utilizing for client accounts, you're saying those same defensive options, high quality bonds.
Yep.
dividend paying stocks, money market funds. These are some of the alternatives available.
Oh yeah. And I mean, it's, at least you're going to earn something, and there's no risk to it in most cases. So that's another thing that we try to show people. And I'll tell you the one that is really good still right now are these annuities. These annuities can do so much more with less money because of what the interest rates are right now. They're the highest they've been in my 31 years in the industry, and we are still locking people in at great rates that are just going to give them guaranteed payouts that I thought I'd never see in my career.
So far too many people taking far too much risk, and
Yes.
that's possibly equating, Tim, to more losses than are necessary or justified, even with the money intended for growth. These defensive strategies and these options are available. What are some of the reasons, and how does the annuity that you mentioned help protect us against market losses?
Well, let's talk about why we would use them. I think let's start there, and that is this. When you go into retirement, it's all about income producing vehicles, whether it's your stock that's paying dividends or what have you. But that's not guaranteed. These annuities are guaranteed and they're backed by the insurance companies that are A-rated or better. And so when I have clients in a protect and grow blueprint and the market goes down like it is right now, they know that they're able to pay their monthly bills and no matter what, the market be darned, it doesn't matter. And that's the difference is to be able to do that. And that's why they're able to, they let you share in the growth if there is some in the market, but the worst they'll do is a zero. And a lot of people have negative ideas of annuities. I find most of those people don't really understand them. But they're happy as heck to have Social Security. They're happy as heck to have their pensions, but they don't like an annuity, which is the same thing. So once they get educated, maybe they even read the book, they find that that is, something that's makes them happy to have guaranteed income and be able to pay your bills.
Tim, from what I have seen and read, the purchase of annuities, the deposits to annuities have grown year over year and continued to kind of break and surpass records of previous years over several of at least the last 5 years. Are Americans starting to see the value in converting some of this lump sum that we've accumulated inside of our 401ks into an additional pension style kind of type and like income into and through retirement?
What I see is this: many of these baby boomers were raised by, their mom and dad that had pensions, and they've seen that their parents have not wanted for anything in retirement because they have guaranteed money coming in, and now they're getting ready for retirement, and they want that. They want to have the stability of having guaranteed income month to month. And so we're seeing people move money out of stocks, out of bonds, that are shaky at best, and moving them over into, annuities that are paying out better than they've ever thought of in a dividend paying fund or anything like that. Of
Well, again, it's just one of the options. And Tim, I think that
course.
people are finding the consistency, the dependability, durability of the income that can be counted on and relied on from an annuity payment as an attractive alternative to the wild rides and the ups and downs and the fluctuations of the market. Um, how do you know when an annuity is appropriate or how much to put in an annuity, Tim?
It's actually a lot easier than people think. With doing a protect and grow blueprint, you figure out what they have as bills. You figure out what their guaranteed income is from, let's say, Social Security or pensions if they have them. And then you figure out what that gap is. And then you either backfill it with an annuity or you tell them that you're taking risk on your stock portfolio to be able to pay that gap. And I think a lot of people right now are a little bit frightened by that when they saw their values, dip, so quickly. In 20% in in a week, couple of weeks is pretty crazy for some of these high flyer stocks.
And if you're seeing that and getting nervous, Tim, probably an indicator that you are taking too much risk or you don't have
Mhm.
a protect and grow retirement blueprint.
Exactly. Winging it and hoping and all that type of stuff in retirement is not the way to go through retirement. You need to have a plan. And, I dare say, when you're building a house, it's important to have a blueprint. I dare say this is more important because retirement, if you screw up, you're one shot at it. What's next? You go back to work, you go live with your family, you ask for the federal government to help you. These are things that fall on our shoulders squarely. So get a plan.
Yep. And again, if you would like that Protect and Grow written retirement blueprint designed for you, specific, personalized with long-term vision and diversified strategies, pick up the phone, give Tim Stearns and TJ Stearns Inc. a call, 800-640-2256, 800-640-2256, 800-640-2256. Tim has additionally made an offer on the program today for the first 10 callers. If you've got at least 2 million saved for retirement, a copy of the book, Solving the Modern Retirement Riddle. Some of the strategies are specifically for those who have saved and invested and built up a net worth and lump sum savings that want to understand what it takes to transition that into lasting retirement confidence. If that's you, pick up the phone. 10 of those books available on today's program, as well as the offer for that Protect and Grow written retirement blueprint. 800-640-2256, 800-640-2256. So, Tim, some of the strategies that have been deemed as more defensive or conservative. Asset allocation and diversification, kind of a core principle of balance, right?
Yes, but I'm going to give a caveat there with the 60-40 in 2022. It was one of the worst years for it. And over the last 25 years, the, asset allocation has failed people so many times where stocks and bonds actually went down, which, when I first got in the industry, they had an adverse, relationship. One would go up, one would go down. So asset allocation kind of scares me. I feel like, you think you're not putting all your eggs in one basket, but nowadays it appears you are. And so I'm just, worried about people thinking that that's a fail safe, that, oh, well, the stocks will buoy me and that when the bonds are down and vice versa. That has not happened in the last couple times that we've had a correction in the market. I wish that wasn't true, but it is. So that's why we've been using more and more annuities in the place of the fixed income option of bonds.
Um, Tim, I know that today trading is accessible. We can do it. It's more of a commodity. There's plenty of platforms and institutions out there that allow us access, almost instantaneous access to buying, selling, and trading. What about the time-tested buy and hold approach? Is this any more conservative or defensive in your mind? And can you compare the virtues of the two approaches?
Yeah, sure. And by telling you this, what is the number one mutual fund company that is a buy and hold mantra at all times? Vanguard.
Mm.
And what are they doing right now? They're going out and buying actively managed companies, because they feel like the buy and hold has kind of been passé. And they're not trying to time the market, but they are being active. And that's kind of where I'm at, as far as my beliefs. We don't buy and hold because I don't want to see my clients do so well the last couple of years and have it all eroded, within a couple of weeks, which I've seen from people that we were trying to get on board with us. They're not real happy that they didn't sign up. Our phone's ringing off the hook.
Uh, so, Tim, we should have a long-term vision with our plan,
Of
but not
course.
necessarily holding the same positions forever and ever. Is that
Yes,
an accurate
exactly.
summation?
Yes, in a protect and grow blueprint, we're going to have, you're going to have guaranteed money coming in from, let's say, the annuities. And then if you do have a stock or a growth bucket, we're going to have, stop losses. We're going to have covered calls. We're going to do things that will give us a fighting chance if the market does what it just did.
Tim, if we are in our working years, dollar cost averaging, maybe not conservative or defensive, but another kind of time-tested strategy for long-term growth and progress.
And I would never stop doing that. If you're in a 401k, or if you're putting money into an IRA throughout the year, dollar cost averaging, I do believe in. It's the buy and hold that I have a problem with for people who are older that don't have time to make up if the market corrects.
Uh, but Tim, once we move into retirement and the direction of money reverses, dollar cost averaging out or reverse dollar cost averaging from the market as it fluctuates, that actually can be particularly dangerous.
I agree. And that's literally sequence of returns risk, where you're taking out more than you actually meant to. And that's, again, having a plan. I don't understand these people who think that they're just going to kind of wing it in this volatile market. Things are moving by the minute, and I would be very careful right now.
All right. Well, again, we are talking with Tim Stearns, CFP, president, founder of TJ Stearns Inc. If you would like your personalized protect and grow written retirement blueprint, pick up the phone, give a call, 800-640-2256, 800-640-2256. Tim, more defensive or conservative, prioritizing income focused investing. I think you've probably mentioned this a couple times already, but why do we particularly focus on income with an investment strategy?
Well, think about it. What is retirement all about? People come to us and go, "Hey, I have X amount. Is that enough to retire?" And the quick answer is, I have no clue because we don't know how much money they need to come from their portfolio. It's all about being able to pay your bills. So if we really, put the screws to them and make sure that we understand what their bills are per month, and then build a protect and grow blueprint. Next thing you know, they've got a solidified plan that has a growth bucket for the things that they've never been able to do over their working years. And then also, if God forbid they need a new car or something happens with the house, we're covering all the bases. And I don't think a lot of people understand what all those bases are.
Well, again, if you would like to address the risks, if you'd like to solve that modern retirement riddle, give a call now, 800-640-2256, 800-640-2256. If you'd like your own personalized protect and grow written retirement blueprint, you can reach out to TJ Stearns Inc., Tim Stearns CFP. They will personalize a plan for you and your situation, an analysis of the current accounts and the investments that you own, and bringing them all together and in alignment with your risk tolerance and your long-term goals. 800-640-2256, the number to call, 800-640-2256. Rebalancing periodically, Tim, also important. Is now a good opportunity to do things like a rebalance assessment?
At least an assessment, to make sure that you're not overemphasized in these stocks that got you in the trouble that you're in currently. And I know the theory is, well, they'll bounce back. Well, when? And how quickly do you need your money? And with that, I would tell you, get guidance from someone who's a certified financial planning practitioner to say, hey, if you're going to rebalance, we do it here, but not there.
Well, market volatility can be unnerving. If you have been nervous about the market, if it has made you at all uneasy, that may be a sign, a signal that you do not have a true plan, or that the plan that you do have is not specifically tailored and personalized for where you are in your financial progress. Having a plan can help not only with the financial results, but also with the psychology of investing. So pick up the phone, give Tim Stearns, CFP, a call, get that protect and grow written retirement blueprint, as well as the book Solving the Modern Retirement Riddle, 800-640-2256. That's 800-640-2256. Tim, we always appreciate the time here on the program. Thank you for being the resource and source of information and education that you are there. TJ Stearns.
Thanks, Peter. Thanks for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC.
The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.